get finished product or services into the hands of the consumers. All right, so we have also controllable costs. Uncontrollable costs, quite important. It's quite true that there are some costs that you will have a certain degree, that the manager will have a certain degree of control. But there are also other costs, like let's say taxes or municipal rates. You know, the manager will not really have a control over those costs. So quite important. But you do have also quite a nice table, which I love, you know, to use, because you can see that the controllable cost is always short run versus the uncontrollable cost. It's true that the taxes, they don't just change, you know, in the short term. Taxations, they stick for quite a long time. All right. So we have also the sunk cost, any cost that has been incurred that cannot be changed by any decision now or in the future. It's already done, sunk. So we have the sunk cost, something that you should also understand. And then my favorite will be the opportunity cost. Very important to understand this one, because it's always about the best alternative that is not chosen. When we're making a decision right now, we need always to think about a better alternative, that we are investing in idea A, but we need also to question ourselves, what about idea B? So the opportunity cost is what we are missing out when we are investing in idea B, sorry, in idea A, what we are missing out from not investing in idea B. And that's why we need to be able to compare these two. We need to be able to calculate what exactly we are letting go. Let's say that you would have had a 15% return in this project, but then you invested in a 10% project. You can see what is the opportunity cost here. What we have forgone for not investing in idea B is 5% more. So I hope that you know, with the help of imagery, you can understand what is being said here. So it's the cost of choosing uh, 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 for you know, of choosing a particular thing, a particular solution, a particular anything that you are choosing, but you must consider the cost of the next best alternative that you have not chosen when you were making the decision. All right, that's quite easy. All right, so we have a good example here. Has anyone touched this example? Rabia, Ashi, did you touch on this example? So in this particular example, what it's going to tell you is basically it's a good example to help you make the difference between what is manufacturing. Oh, not yet. All right. So when you come to this example, all of you who are listening to the recording, when you come to this example, just remember to this will just help you to exercise and on your ability to make the difference between manufacturing cost and non-manufacturing cost. It's a good example, and like I always say, everything is in the reading. Make sure that you read every single line, every single dot, to make sure that you understand what really the cost is about. Because sometimes things can be quite tricky in the sense that, for instance, here, let me just give you an example. When you come here, it's quite important to see that the cost that is put here is an annual cost. And that's why you need to pay attention to the details. This is an annual cost, although we were talking about a particular month. The question referred to the month of March. So we were dealing with the month of March, but yet look at this cost is an annual cost. And therefore, we understand that if we would need to reduce it at the level of a month, we will need to divide it by 12. So these are the kind of things you need to pay attention when you are reading these questions, especially in your papers and all these kind of things. Pay attention to the details. Another good example here is that the total floor space of the business premises was divided into two. And if you look clearly here, the three-quarter of the business, three-quarter of the business of the floor space, of the total floor space, was devoted to the factory, and the one quarter, a quarter of the space, a quarter of the space was devoted to the office area. So you need to be quite careful when you are reading this detail. This says a lot of things. This says a lot of things. It means that the rent that they were paying, whatever rent that they were paying, you need to divide the rent in this on this fraction so that you can know which one is manufacturing cost and which one is non-manufacturing cost. I hope that this is clear. And again, what is this saying? It is the attention to the details. When you are reading, don't just read and say, oh, it's quite boring. I'm not even understanding what he's saying. Every little details that is being given to you must be for a reason. So it's quite important to pay attention to the details. Otherwise, you might do calculations and then all those calculations end up being wrong, completely wrong. You missed completely what was being asked because you didn't understand properly. So it's quite important again, same rent, but that rent, you must also remember it's a cost. Okay, remember we touch on that. And this will be a good example, rent. It's a cost. But are we gonna make it? Are we gonna directly call the rent a manufacturing cost or a non-manufacturing cost? It depends. We need to find out if that rent is specific to the factory, to the manufacturing side of the business, or if that rent was for the admin office. So you need to understand exactly what was the purpose of that rent in order for you to properly classify the cost. So I trust that that's crystal clear. Okay, so it seems like we're doing quite good on the time. And let me see if I can touch on something here. There's quite a few examples, and the solutions to those examples are there to help you understand. But this is, for instance, about allocated according. So when we are talking about the manufacturing overhead, we will talk about what is the manufacturing overhead. This is indirect cost, right? We know that it is not directly linked to the particular product being manufactured. Okay, so rent will be one of them. It's not directly linked to the particular thing that we are that is being manufactured. Just if you allow me all the time for just a second, if I make a mistake somewhere. All right, okay, so but as we were talking about this, you can see that the monthly cost for the rental cost, as you can see, there it is. Because what happened is that we need to understand that three-quarter, which is, look at this space. So we said this space was if you do fraction, you know your fractions, right? I hope all of you know your fractions. So you understand that three-quarter of the business is devoted to manufacturing. So the total rental cost was 10,000, right? Okay, it is as easy as that. So three-quarter of 10,000 is 7,500. So this is important, and this was given to you was given to you, it was written clearly, but you need to understand if you see something written in a problem, it's definitely something that you need to take into account. Okay, but for instance, for the admin building, which was the quota of the expense will go to the admin building. So we have the quota would be this minus this. We know that 2,500 will be the renting for. Am I right in saying that? Okay, we shall find out. We shall find out. So when we are talking, for instance, about the admin, the administration cost, I'm not the administration cost. Look here for the rental. This is not a manufacturing cost, as you know. Remember again the division: manufacturing, non-manufacturing, manufacturing, non-manufacturing. Admin, marketing, selling is not manufacturing. It is not linked to the actual product that is being manufactured. So if they ask you for the administration cost, look at this rental cost. Look at the amount. It's exactly what I told you there, is that, and this was given to you clearly in the problem. So I expect when you go for an exam that you properly read each sentence to understand what is the reason for this. Look at the rental amount was 10,000 per month. You don't just jump straight and then you take the 10,000, you make it a manufacturing cost. So need to pay attention. Again, another cost is here. It is the rate and taxes. Look at the rate and taxes, and look at what I say. The rate, the rental cost, rate and taxes must be a proportioned according to proportional floor space. So the same calculation we have done here, it's the same calculation that will apply when you are doing for the rate and taxes. Same calculation. 3/4 will be for manufacturing and 1/4 will be for non-manufacturing. How am I doing, Rabia, so far? Just checking on you. Is this clear? Is this making sense? Just let me know in the comments below. Just let me know if it's making sense. All right, so especially with regards to, I'm not too sure what happened here with my actual, okay. Awesome, 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 awesome. And guys, remember again, you have a question, don't hesitate. There's quite a few examples for you, but I want to quickly go because quickly advance because I don't want to I want to be clear on the details and all these kind of things, but I want to make sure so that I'm covering everything that is quite important. Remember, this will be the most important part also. Fixed and variable cost, a whole thing, quite important. You need to understand these costs and how these costs work. If you understand these costs, your everything will be quite easy. Fixed, as we say, it is fixed, but you need to understand there is always fixed at the level of the of a unit of a particular item and fixed at the level of the total. The same as the variable cost. You need to understand that what is the implication of the variable cost on the unit, per item, and the implication of the variable cost on the total units of a particular production. So this is quite important. And that's why you see this. This is not for nothing. This is quite important why they give you this. So because we need always to remember that the volume is quite important. How many? So we have a number units here. If you can see you are talking about the volume of the production. Okay, so if volume of the production goes up, it goes up, how does the variable cost react? The total variable cost will increase because the level of production has gone up. Let's say we have 10 shoes that we're producing, and the unit cost of that particular variable is we are selling them for 500 rand. It does make sense that if we increase this volume to 15 times 500 will be greater than 10 times 500. So that is quite common sense. So, but remember, that will be on the total. The total will increase, but per unit, it will stay constant. It will stay 500 Rand. The pair of shoes is still 500 Rand. The pair of shoes still 500 Rand, but the volume will increase. If the volume of production increases, our total cost also will increase. So that's quite clear. All right. So, but if it goes down, it also goes down, as you can see. But per unit, it stays constant. But for the fixed cost, it's different because it for the total, the fixed cost stays the same. If we are paying rent 5,000, that's the rent we're paying every single month. The total rent that we are paying every single month stays constant. But per unit, in order for us to find the total cost per unit, we would take this 500 rand that we are paying for rent, we divide it by by the number of pair of shoes that we are making. So it's not 500, my bad here. So it's 10, right? So we have our production, our previous production was 10, right? 10. So it is 500 per unit for the fixed costs. We are talking about the fixed cost, all right? So, but if our production increase, so we will take 5,000 divided by 15, and which would be obviously less, which will be obviously more. No, what am I saying? Less. Yes, because you are dividing by a greater number here. So I don't have my calculator with me. Let me see if I can get a calculator quickly. Shame. I wish my brain was a calculator, but okay, always have a calculator. Why? The reason is when you are writing an assignment and you use your brain only and you don't double check with the calculator, you might be losing marks for nothing. Okay, so here the answer will be 300, 3, 3, 3. So 300 and 300, 300 and 33. If you can see here, per unit, this is per unit. Look at the difference, 500, the fixed cost per unit 500 to 333. You can see that it's decreased. So as you can see, if the production goes up for the fixed cost, if the production goes up for the fixed cost per unit, the fixed cost per unit decreases because we have more shoes that we are making, and therefore if we divide the fixed cost per the more shoes making, it means that it's going to decrease. So this is quite important for you to understand. And why am I saying this? Say, oh, it's really not interesting really at all what you are saying right now. No, it is so important, because when you're going to be doing this calculation, when you come to the concept of CVP analysis, CVP analysis or breakdown. This is very, very important because you need to find the break even, uh, uh, the break even uh, uh, um, uh, uh, of any production. When are you breaking even? So this will help you if I can say it is a breakdown for how you get to your production, which is your total revenue matching your total cost. We are making zero profit at this point, but we broke even. So that's the break even analysis. CVP analysis is similar to break even analysis. Let me not confuse with breakdown, but what I'm saying is that it was breaking down all these costs. So let me just say break even for you to not be confused. So how are we doing? Rabia, how are we doing? Even. Right, so this is quite important. Awesome. So making zero profits. Yes, we're making zero profits, but we broke even. You see, so but the total revenue equal to the total cost. From there, we start making profits. But remember, you bought quite a few things. When I say you, I'm always referring to you as the entrepreneur when you are doing your business. And these things are quite important: marginal cost, marginal income, marginal cost ratio, marginal income ratio, net income, and net profit. Very, very important for you to understand. Okay, I'm tempted to take one particular example to make you understand all these things, but I need to touch on these marginal costs. So because the marginal cost will be the cost of producing an additional unit. So quite important, the cost of producing one additional unit. And look at the marginal cost formula here. We're looking at the change in cost production divided by the change in quantity produced. The change in cost production divided by the change in quantity produced. Because why? Why is it a change in cost? Because we are looking for a cost with regards to the volume, quantity. Every time I mention volume, think quantity. All right. There's a good example for the shoes here as well. 5,000 divided by 100. Okay. The marginal cost is 50 rand per shoe, right? Because we have the change in cost production. Let's say it went from, oh, let me just rather use this example. It went from 35,000 to 40,000. So the change is 5,000. So this is the change divided by the change before they were producing 700 shoes and now they're producing 800 shoes divided by 100. So it's 50 per shoe. Important to understand. Marginal income. The marginal income will be the contribution or the contribution margin. Uh, uh, it, the difference between sales and variable cost. Quite important. Sales and variable sales and variable cost. And why is that? And that's why I mentioned this. It is used to cover the fixed cost because sales minus variable cost gives us the fixed cost. So the marginal income, it is that income that is used to cover the fixed cost. And this is by the way, my own definition, not totally, because